How do you put this in perspective to bring out, what is unique about Tata Small Cap?
As you rightly said, the universe is very large, between 5,000 and 32,000 odd crore. First of all, our investment philosophy is growth at reasonable price. Buy businesses at a time when nobody is looking at those businesses. Fortunately, the universe is very large.
So that's the secret sauce, yes. Hi everyone, I'm Shaily Gang. I lead the products desk at Tata Mutual Fund. And today we will talk about Tata Small Cap Fund in this podcast. Its DNA, its unique features, the risk management measures deployed by the fund manager, the unique style of the fund manager, Mr. Chandraprakash Padiyar. He is someone who thinks about calendar year 26 and calendar year 27 returns as well, and not just is sensitive about the next 6 months return. And whenever I think about this fund, Tata Small Cap Fund, this one thing comes to my mind. Great things happen in the long run. Hi CP. So small cap as a space is a little different and quite different rather from large caps. The universe is very, very wide. The benchmark is again very wide, and liquidity is a very, very important consideration. And growth rates here can be very high, maybe from 50 to 100%. So how do you like investors to think about small cap as a space?
So, hi Shaily. So, the first thing that I would say is that classification for small caps changed in 2018. Or let's say definition of small caps changed in 2018, large, mid, small. And the reason I say this is that pre-2018, whenever investors thought about small caps, they used to worry about volatility. And they used to worry about cycles. They used to worry about deep losses over a period of time. And less stability in earnings for businesses. What changed in 2018 is that a standard definition came by, which is top 100 is large cap, the next 150 is mid cap, and anything below top 250 companies in terms of market cap ranking became small caps. So for example, in our fund today, Tata Small Cap Fund, we consider our universe, though the universe is very large, but we try and build our portfolios between 5,000 crore and 32,700 crore, which is the 251st company today. And as you rightly said, the universe is very large, between 5,000 and 32,000 odd crore. There are more like 600 plus companies to choose from. But the interesting thing is that most of these companies that we select from are leaders in their respective sectors, do not have leverage on their balance sheet. They are doing something in R&D about their business to gain scale in India in manufacturing and exports as well. And the close to 60% plus of this universe that I am talking of is all about manufacturing. So if we are talking about Make in India or Atmanirbhar Bharat in India or Make in India for the world, we find interesting opportunities in this small cap space in this universe. You make a very valid point that liquidity is very important because these businesses are relatively liquid in nature. Sometimes quality of corporate governance standards may also not be as strong as, or on a relative sense, relative to large caps. So you have to dig deeper, you have to go deeper, you have to meet the management teams, work with the managements to see what kind of board arrangement do they have, what kind of standards do they follow, do they want to reward investors for the kind of business that they are running or generating. So it does matter because liquidity hurts you in the worst times. So if something goes wrong in a business, then illiquidity of a business can actually be very painful. So in our fund, when we look at investing in a small cap in our universe, we are typically focusing on the quality of business, the management team, the style of running the business, what scale they can achieve. Like you said, we don't look at just 1 year, but we actually look at long term. Our average churn has been for the last 6 years been less than 0.1 for the fund. So we don't buy and sell very often. We buy and hold for a longer period of time. We buy with conviction. So that happens only when you build good quality portfolios. In that sense, you don't have to worry about liquidity actually.
Great. So we have seen data for Tata Small Cap Fund, and we've seen that we've seen the 5-year data from Jan 2020 till December 2024, and in the months where Nifty Small Cap 250, which is a wide benchmark, has been negative, Tata Small Cap Fund actually, on an average, has fallen half of it. So I'm saying that when you take a 6-month daily rolling average, and you take an average of all the months where Tata Small Cap Index 250 index has been negative, this fund has fallen half of it. And on the upside, it has almost captured about 95 to 97% of the upside. This is one part of it. The other part, which we all again know, is the unique features about this fund, which is it's a bottom-up fund. It is also runs benchmark away, which means takes active bets, and buying early, which you just mentioned. So it buys early. How do you put this in perspective to bring out what is unique about Tata Small Cap Fund?
So yeah, so what we do in the fund, we are first of all, our investment philosophy is growth at reasonable price. So we look for companies which can grow sustainability, scale their business over a period of time quite significantly. We look for companies which can steadily keep growing at a faster pace over a period of time, with profits, with cash flow, with stronger balance sheets. So that's the first criteria, which is growth at reasonable price being the investment philosophy. When you do this, which is one is growth. If growth is available, most of the times market will not leave anything extra for you on the table, which means that valuation would be more or less full. And hence you need to be early. So you need to buy businesses at a time when nobody is looking at those businesses. Fortunately, the universe is very large. So not everybody can do as much research. So you have that ability, or you have, if you want to, you can identify businesses which are outside of research coverage of most research houses or fund houses. So hard work is required, obviously, but there is opportunity available. The second is when you buy early, the advantage that you get is that you are able to buy when everybody is selling or nobody is bothered. So you get to buy the desired quantity of stock, given that this is an illiquid part of the market. You get to buy as much as you want at your price.
Yeah.
So your risk reward. So the first thing that we look at is what is the risk reward that we do it today. So if at 100 rupees, if I'm buying a share price or a stock, we generally look for what is the risk that I'm playing for. What is my downside, and potentially if the business delivers or management team delivers in line with what we expect them to deliver, what is the upside? And typically we look for anywhere between 2 to 4x our risk reward. So if the downside is 10, the upside should be 40. That's the kind of ratios that we generally focus on. That helps us deliver good performance over a period of time. The other thing is that generally, as you said, we are early. And though it is a learning phase, all of us keep learning over a period of time, but we try and be early just in time, meaning that sometimes 1 year is too early, sometimes 1 year is not so early, depending on the way the markets are. So for example, when I started managing in 2018, between 18 and 2020, markets were quite weak. So we did know that we bought very good kind of companies. But for 1.5 years, nothing happened. The markets were weak, our performance was also weak. But then when things picked up, suddenly you saw a hockey stick approach where our stock prices did extremely well. And since then, we have not looked back. So that's the interesting part, is that sometimes the patience required is very high from an investor perspective as well. But the good news is that our research is so great, so quite positive and disciplined, that we try and that our conviction levels are high. So even if stock prices go down, we don't worry too much about volatility in stock prices. So these are some reasons why we believe we are doing well. Generally, I've seen in our market, as you rightly said, churn levels are higher in this industry. Generally, investors I've seen tend to buy for 1 year, 6 months, 3 months as well. They try and make short-term returns. That gives us opportunity to buy businesses for a longer period of time and ignore the short-term noise and try and make better returns over a period of time. So that helps us. And on your point on why we have done better on weak cycles especially, is that typically what has happened is that during good times, always, in fact, there have been now 3 cycles in the last 6 years, short cycles, where markets have corrected. And what we've been doing is that every time when the markets are going up, we are busy changing our portfolios. So when everything is doing well for us, we are booking profits in businesses which market wants to buy, and we are buying businesses which market doesn't want to buy. Or we are trying to reflect on what balance you can do so that you build your portfolio for the next good cycle.
You're ready for the next
So
wave.
you are preparing always for the correction period coming. For example, in 2023, when the markets were booming, we changed almost like 60% of small cap portfolio. So 2023, we gave away part of returns for the market. We did not participate in the full rally. But when 2024 came, when markets have been very volatile, we are outshining our performance because we were changing our portfolio in 2023. Similarly, 2024 and early 2025, or let's say last quarter of 2024 calendar year, we've been busy changing our portfolio again in small cap.
Yes.
Because most of our companies did well in 2024 when markets were not doing so well. So as we speak, we once again have a very different portfolio than we had at the initial part. So we think we are very well prepared. And so when you prepare yourself well in advance, so when markets turn around or turn volatile, and if your set of companies start delivering good earnings, which we expect from the new companies that we've added, we tend to typically do very, very well. So we are at this time, especially when markets have corrected so much, a small cap index would have corrected by 20% from its peak till yesterday. Even our portfolios have corrected, but less than the market. These days we are quite excited actually because we believe that we've been able to buy businesses where earning growth is likely to be very high in the next 2-3 years. And we've been able to buy businesses where valuations are reasonable. So unlike the last 1 year where we've been cautioning investors on small cap, generally as a segment, because valuations were running high and we were selling and booking profits, and we were not very happy with incremental return that we could generate given the valuation. I think today things are looking different. And once again, in a very short period of time, I think the environment has changed. There are many businesses which corrected by more than 40% from their peak. That has given us opportunity to deploy capital. We are back to closer to 5% cash now. We used to be 10% for a very long time in 2024. So we are deploying aggressively, and given the valuations that there are today, I think it makes us optimistic to generate performance for the next 1, 2, 3 years.
That's the secret sauce, yes. Buying businesses early and buying when others are not looking at it. And of course, in that, you have to manage some of the shorter cycles and volatility which those stocks might go through because of buying early. And the result of that is, I think, what you explained very well is that the outperformance which comes in during weak phases or narrow bull run or flat phases outdoes the little bit of temporary underperformance which might come in during a very sharp, broad-based bull phase because you are buying the right quality businesses.
So I can give you one example on this is that, let's say, just yesterday, one company of our portfolio and a large part of our portfolio delivered their earnings yesterday. So to step back, generally small cap manufacturing companies are B2B companies. What I mean by that is that they sell to another business. And when you sell to a business and you are manufacturing, you are never going to be steady every quarter. There will be lumpiness always every quarter. Especially Q3 is a weaker part of the year when there are lower number of working days and economy is generally on the slower side. There is festive season as well. So you tend to see volatility in earnings delivery by such companies. For example, this company that I am talking about reported flat earnings for the quarter.
Okay.
For the because of which you see on a 9-month basis that have been reported for FY25, earning growth looked like a 9% growth for a 9-month period. But the order book is so large and has increased after Q3 numbers that we believe that they will be easily be able to grow at 20% plus this year and the next year and the year after. So And what happens is that in a weak market environment like what we are in today, the stock has got punished by almost like 25% in the last pre-result. And now after result today, and I'm assuming hopefully things go well, if they deliver their earnings, we'll go back to that number or higher in terms of stock price very soon. So you have to live with this volatility in small caps. If you do not buy businesses with conviction, and if you do not think long term, you will end up selling at wrong times and you will end up buying at wrong times. So that is what I meant when you have to preempt people and you have to buy as when things are going wrong.
Yes. No, great to understand this, buying early with an example as good as this. On the risk management side, CP, I think it's that this angle and this topic is very close to especially the small cap space. So how do you do stock position sizing of the stock positions basically, and also on the other side holding concentration of companies basically. To what extent or what percentage of the portfolio can buy what percentage of market cap of the companies? If you can throw some light on this side of fund management.
Yeah, so first of all, in line with our philosophy, or let me step back. From my experience of last 24 years, I've learned one thing in managing money is that not all 100% of your portfolio needs to be in re-rating candidates. Meaning that I've done this in my past and I've realized that investors do not generally have patience and everybody wants to see consistency of performance with peers and benchmark because there is so much choice for investors to choose from. I may have 100 stocks where I think re-rating will happen and hence I will buy with conviction. But ultimately I can buy only to the extent of money that I get from investors. Which means that you have to balance your portfolio. So from learnings, what we do in small cap is that in our fund is that we balance our portfolio 50-50 mix, which is that around 50% of the portfolio we would buy into businesses where we expect re-rating of valuations over a period of time based on the high earning growth that these companies will deliver. And since we are early in the game, we have bought at quite attractive valuations for such names. So that's the first 50% part. And 50% of the portfolio is in compounders, long-term compounders where growth is there, but most of the times valuations may not be very attractive. We are not playing for re-rating there, but we are playing to move with the market. This part of the portfolio tends to be more liquid also because it is well appreciated by the market. So there is buying, selling happening, very high activity happening in those stock prices. So it helps you provide liquidity of the portfolio as well as move with the market and peers in terms of performance in the short period of time. And the 50% of re-rating is generally very illiquid at the time of buying. You can buy, but you can't sell. Till the time those companies deliver earnings, you have to have patience.
True.
Because you are buying at a time when nobody wants to buy. So everybody is selling to you. So buying is easy. But selling at that time is not easy. So you have to pace. So your question is very valid. You have to pace your positioning of this 50% of the portfolio depending on the timing that you believe that re-rating will come or that earning delivery come. So some names I would buy for the next 6-9 months. Some names I will even buy for the next 2 years. Earnings may come 2 years later.
Yes.
So you have to position your portfolio because it is not in your hand when the market will re-rate those businesses. So you have to balance in a manner that you have all kinds of names. Something will deliver now, something will deliver later. That is so it's more an art than science actually. It's sometimes gut feel comes in of a fund manager, of the investment team, of the research analyst. And so that's what we follow. So that's the first thing. On liquidity, the way I think, there are two things that I think about. One is what is my liability profile? In the sense that my top 20 investors, in case they decide to sell on one single day or redeem from my fund in one single day, what is it that I need to create as cash on that day? The good news is that our AUM today is very granular. Top 20 is closer to less than 3% of our AUM, which means that even if I keep 3% or lower cash, I can manage without selling in the fund. But we tend to keep on an average last 6 years. If you look at my performance, generally our cash levels are between 5 to 8% on an average. So we have adequate liquidity to keep for a very uncertain environment. In case a large proportion of investors decide to redeem on one day, we are prepared for it. The second thing, the way I would think about is that what proportion of my portfolio is into companies where we own more than 3% of equity capital of a company.
Yes.
The reason I think that way is that if I own 3% or higher of a company, the ability to churn faster goes down materially. Because you can't sell as much of equity capital in 1 month or 15 days, or you have to wait for your time. And that proportion of portfolio will be very illiquid for you. You have to think as if that you are part owner of a company and you will own for a longer period of time. So today, for example, that number for us is around 24%, which in my opinion is a reasonable number to continue with. The moment it will cross 40, I would say that it will worry me. Which means that as of now we are okay. So this is something that I monitor.
Very
so
impressive.
These two things.
Stickler for entry price and planned exits. I think taking care of the fund and the investors on both sides, which is so very important in a space, especially like small cap. Cash, of course, you already mentioned, but are there any guidelines to these exits, which you plan, which means that what percentage of, or before that, how long would you wait if the re-rating is getting delayed, let's say in few stocks, and to what extent, to what percentage of the portfolio would you be okay with the delay? Is there any such guideline that you follow for exits?
Yeah, so we do have a guideline, but first I must say that last 6 years we've been very lucky. We've not had any amount of, or any major amount of disappointments in businesses that we have bought. So in a different term, I would say that there has not been too many mistakes that we have made in terms of buying businesses or overestimating earnings, and it didn't happen, and hence the stock price underperformed. We've had 1 or 2 cases, but very small as a proportion of the portfolio. But in terms of guideline, you make a very valid point. What is the risk management that we do actually? Is that from a performance perspective, is that I think, and this is from experience again, there is no science to it. We will apply this formula to over a period of time and learn from it over a period of time. But today what we think is that till the time 20-25% of a portfolio is underperforming or not doing well for you from an earnings delivery perspective, you are okay, because 75-80% is still going to perform or is performing for you. So that means that you are still okay to live with it. Give it more time to deliver earnings. But the moment this part of underperforming part of businesses where managements are not delivering to your expectations goes beyond 30%, it starts impacting the overall performance. Because the stock price of 30% plus of your portfolio, if it doesn't perform, it starts impacting your overall performance. So the way I think about it from a risk management perspective is that, and this is to a kind of, sometimes fund managers tend to have emotions as well from a stock. Since I have bought this business, done all the hard work, and if it is not, there is always this hope that management will deliver. So to remove this emotion part, the way we will take care of this is that the moment this crosses 30-35% of the portfolio, not an exact number I am giving, but a range of percentage, we've decided that we will sell at least half of our portfolio of this underperforming part. So which half we will choose at that time, but that will help us remove emotions from that decision making. So as I said, fortunately last 6 years have gone very well for us. We have not had too many mistakes. But in future, if this happens, we will sell at least half, if not full, of this underperforming part and replace it with new sets of companies. So hopefully that will take care of the risk management. We are focused on, as a team, trying to be on top of everything, trying to understand what is the trajectory of earnings in the short term as well as long term, and if there is any change that is likely to happen there.
Great. When you're right, be right by a great margin, and whenever you're wrong, be wrong by a very small quantum, I think is the philosophy that this fund follows as well. So a true bottom-up portfolio, Tata Small Cap Fund, taking active bets along the way away from the benchmark and buying early. That's a very important part of this portfolio. Using judgment to the T in terms of entry price and being a stickler for that, and planning exists. So it's a very, very balanced approach, very well balanced on the risk management as well, not just on the investing side. So I wish all the investors happy investing in Tata Small Cap Fund. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.